Okay, and with us today we have Carlos Pena, Commercial Director, Sea Transport Maritime. We have John Wobensmith, CEO, Genco Shipping. We have Heiberg, CFO, Golden Ocean, and Loukas Barmparis, President, Safe Bulkers. We have Stamatis, Tsantanis from Seanergy Maritime. And last but not least, we have Mr. Scrubber, Hamish, Norton from Starbulk. Should we just skip coal and iron ore and go straight to scrubbers, or should we do some dry bulk first?
I'd go with the fire and brimstone.
Okay.
Not so much fire and brimstone anymore.
Do we have the slides up here? There we go. Okay, I'd like to kick off with a few comments. On the chart to the right, we show China's energy mix, both in 17 and 18, and it shows that thermal energy accounts for about 75% of Chinese electricity production, of which coal makes up about 70% and gas about 5%. Hydropower is about 15%, and others 10% being wind, nuclear, and solar. And year to date, we've seen Chinese hydropower production being only up about 2%, and other energy is up only 20% off a low base. On this chart to the left, you see Chinese coal production. It's actually down close to 1% year to date, which has led to a relatively sharp increase in coal imports, up 14% into China this year. If you look at the chart to the right, you would see that Chinese coal imports in 18 is exactly where it is at the same point in time in 17 and 16. 17 ended up 6%, and 16 ended up 25%. Where would 18 end? Anyone like to kick off? Is it too early?
It is pretty early.
Probably. Should we start with a break?
Look, I mean, I think it's interesting that the Chinese coal imports have come back so strongly. I certainly coal imports into China, for me, as I've said many times, I think is somewhat chaos theory. I think there are days where you can wake up and the Chinese government has said, no more imports, we're going to focus on domestic only. And then a week later, you have a flood of imports. But I think what's happened this year is there's been so much electricity demand, and there's been a great push in China to bring pollution down, and we're going to get into this on the iron ore side, but I also think it's relevant on the coal side. And so you've seen more and more imports coming out of Australia, and I think the Chinese are putting their money where their mouth is more and more, and actually really focusing on cleaning up from the environmental side and pollution. I think the other side of this story, which you don't have on here, is the Indian coal imports. And I think that is going to continue to be also a major focus for dry bulk, at least for the next 5 years. Coal India, even with all the bluster and the rhetoric of they're going to meet their production goals, they continue to fall flat. Their infrastructure on the rail side is still subpar, so they are having to import higher quality coal, and we're seeing a lot of it right now. It's leading to, or has led to, the strength in the Atlantic Basin. We're seeing a lot of this come out of the U.S. We're seeing a lot of come out of Baltimore off the U.S. East Coast and Hampton Roads. So, look, we're going to end up, I think, pretty good, 14–15% up on the Chinese side, and I'm very positive about India for the next few years.
I fully agree with John. We see it on the day-by-day, mainly even on the Panamax and on the Supramax sector. You see coal coming into India from everywhere, every sources, US East Coast as well. And that is a real game changer on the market. When you see those cargoes coming out, 1 week is very quiet, the week after is very hot. So I think we will have a good China market, but the key is in India in this case. And we are very optimistic on that.
There's a lot of focus on United Nations climate targets, global warming. Chinese coal imports fell in 14–15. Is it a risk that it could happen again, or will domestic production decline and they will favor imports?
Well, I mean, at some point, Chinese coal consumption will drop faster than Chinese coal production. But that point is not close. So I think we've got a few good years left.
When would you expect that to happen?
After I retire.
Okay. And you're clearly going to have 2020 with you. So it's going to be 5-6 years out then, at least. If we switch to the anyone else that would like to comment on coal?
I could say a couple of things here. I mean, our thesis, even in the past for all our presentations, was based on the coal production, the coal consumption, and the electricity and the relationship with electricity production in China. Each country, as we have said several times, has a specific energy mix, which you cannot change year by year. And China has, let's say, certain hydropower capability. They will try to import LNG and expand LNG, but coal remains the key, the key element, the key fuel for their electricity production, and this will continue. Sometimes we'll see that imports will be higher, sometimes lower. There will be volatility, but China will continue to depend in the foreseeable future from coal. And of course, as we move towards cleaner, let's say, technologies and cleaner fuels, they will try to import more fuel, more coal from abroad compared to the fuel that the coal that they are producing locally.
I just want to add, it's also important to know that India is building brand new coal-fired power plants with the kind of the best technology, also with thinking of pollution and air quality. That helps in the bigger picture, though, so they will still continue to consume coal in general. Okay.
If we could have the slides back up again, if we look at the Chinese iron ore imports, they're down about 0.5% this year. And that's despite their domestic production, that's Bloomberg figures at least, down 40% year over year. Steel production up 9% and pig iron production up 5%. So with such strong steel production and decline in production, or on the iron ore production, how come imports year to date are so low? Yeah.
Well, the key word here is the quality of iron ore. Yes, the country might import somewhat lesser amount of iron ore, but they have chosen to go for the higher grade of iron ore, which is actually much, much better for us because that helps the long distance trade. So the higher quality iron ore comes from Brazil, especially the north of Brazil. So that is basically 3 times the distance of Australia, which is the lower grade iron ore. Obviously, they still need to increase, to import pretty much the same quantities. However, the better the quality, the better the ton-mile effect for us.
Yeah, and just to further that sentiment, you know, the domestic Chinese iron ore is something like 20% iron by weight, whereas Australian iron ore is about 62% iron by weight, and Brazil is about 68%, or at least the better grades of Brazil.
In this the past month, the past year, that there was an increased use of scrapping iron ore, of scrapping quantities of steel, and which reduced the needs for iron ore. But this, we believe that is coming to an end. I mean, they have closed all this, let's say, illegal use of steel, and they are scrapping it properly. So I think the situation will move to the normal condition as it used to be.
Yeah, I would just on that, just to throw a little cold water on this. I do see electric arc furnaces growing in terms of use, but again, this is going to be way after Hamish retires, and hopefully after I retire as well. But so now on the positive side, I think you have to look at Brazil and Vale in particular, and you look at their production guidance that they have reiterated time and time again. and you look at their production for the first half, well, they've got at least 35, 40 million tons that they need to make up in the second half. And so I do think you're going to really start to see a strong Brazilian push of iron ore imports over the next month or so. And then as we look to next year, you've got the possibility of Anglo-American and their operations coming back on stream. You've got the possibility of Samarco coming back on stream. So there still is growth in terms of actual projects on a long-haul trade coming back into the market. And the steel industry in China, you know, you may not know it if you read Reuters or Bloomberg, but it's actually doing pretty well. It's up 8%, and we expect that to continue to see growth rates next year. The margins are strong. They've consolidated. I think it's become a much healthier industry in China now.
We touched upon the quality difference, and on the chart to the left we show that the price of 66% Fe content versus 58 is about 2x the price. Is this due to lack of availability, or is it since you could actually defend the price spread of the quality when producing steel?
Well, it's not only the quality of the content of iron within the, you know, the iron ore itself. The thing is that it's got less other pollutive contents. You have less alumina and less other toxic issues that are very serious for the Chinese environment. So that's why, you know, with the same pretty much production of steel, you have cleaner airs in China because you have a better grade iron ore. So that's how it works. It's the quality. It's not only the iron content, but it's the other pollutive elements as well that are within, you know, the product itself.
Since if you look at the chart to the right here, you see port inventories of iron ore in China by quality, Australia, Brazil, India, and others. And then we see that the Australian share is building while they're tapping on the Brazilian inventories. Exports out of Brazil is up 2% year to date, year over year. They've guided a higher figure. Should investors now expect a very strong end of the year?
Well, if I may, the first half of the year, there was a lot of unforeseen events in Brazil that didn't allow for the exports to meet the targets. I mean, they were estimating around 200 million tons to be exported, whereas they managed to export only 175 million. Like John said before, they need to catch up by 25 to 30 million tons in the second half of the year, which now they are doing. They're ramping up the production and exports. And we're seeing that effect by increasing of exports from Brazil. So this is happening now. First half, it was mostly weather-driven and other maintenance-related factors. Now in the second half, they're ramping up and they're, you know, pushing a lot of cargo as much as they can.
Actually, it's Q4, no? So it's when the iron ore should come from Brazil. Everybody's expecting that, and I was only last week in Singapore talking with the miners all around. And Val is still very optimistic that they will reach their target. So hopefully, mainly on the Cape market, we will see that peak coming in the next 30 days.
Okay. If we could have the slides back up. This is our forecast in terms of share of growth by dry bulk commodity. And then in 16, you had about 70% of the demand growth being explained by growth in iron ore. And this year it looks to come in at around 20% and coal around 45%. We get some, at least clients, asking us that the demand picture could look a bit fragile since you're so dependent on steam coal and you don't have that same push on iron ore. Should that change into 19?
Well, if you talk on Capes market, no. Capes is iron ore and coal mainly. But if you go to minor bulk ships, they are moving everything.
This shows dry bulk demand, total dry bulk demand.
I see very difficult that we will get out of iron ore and coal on the bulkers. There is other commodities like grain, important, but the most important are those two.
Yeah, I mean, look, on the iron ore side, again, I still see growth projects that are coming on next year. So I think, again, coal, I just look at coal as this black box. At least in China, I'm optimistic about India. I'm optimistic about some of the other Southeast Asian countries. China needs coal. China needs quality coal, which is from Australia, South Africa. So I think it will continue. I'm just not sure. It's very hard to tell what the growth rates are going to be next year. But let's put this in perspective for a second. We're talking about somewhere around maybe 2% supply growth next year versus 3 to 4% demand growth. And we're building off of a recovery that started somewhere in the middle of 2017. We've got demand outstripping supply this year, so now we're building on that to another year. So that's why at least we're reasonably optimistic going into 2019 from a big picture standpoint.
Okay, so let's do a quick summary then. If you look at our 19 forecast, we have 3.9% ton-mile demand. I'd just like a quick comment if that's fair, low or too high. So 3.9% dry bulk ton-mile demand in 19.
From our point of view, that would be fair.
That would be fair. So one fair.
Yep.
Fair here as well.
I think it will be fair assumption.
Look,
Sounds reasonable.
it should be fair, but the thing is that we need to understand also and see how the overall discussion and trade war continues and see whether there will be another impact. And of course, the impact of this trade war is not a direct impact to dry bulk, but it could be an indirect impact through the reduction of GDP, let's say, of China.
Yeah, although, I mean, our judgment as to what this trade war is likely to do is that the trade war is likely to trigger economic stimulus in China, which is probably directed toward the Belt and Road project, you know, the Belt and Road initiative, which essentially is iron ore and coal.
Yes, now, if you don't know, I mean, they have already done that. So they have
Right.
reduced the reverse rate of banks by 1% starting from the 15th of October, and this will trigger a stimulus package of about $109 billion. So this was the second part that I wanted to say before the interruption, that because of this trade war, we may see that these stimulus patches like the one that they have already introduced will take place, and sometimes we could see even a higher demand than the expected demand, just because as a reaction of China towards the trade war.
And in fact, I believe that the Trump family are big investors in dry bulk shipping.
Oh, they are?
It's a joke.
If we look at on the supply side a bit, the fleet is quite young. 73% of the fleet has been built over the past 10 years, and you have 11% on order. On the chart to the left, you will see average scrap age on the Capesize over the past years. Now it's 24 years. 2 years ago it was 20. If you take out all the fleet above the scrap age, you would take out about 3.5% of the Capesize fleet. Will dry bulk benefit from 2020 regulations from a supply perspective? We're not talking scrubbers now. We're going to touch upon that later. But in terms of how the industry will be affected from a supply perspective.
Well, of course it will be affected because the market, we believe, it's already very, very tightly supplied. And we see that every day, the minute you have 10 ships or 20 ships stuck in different locations, automatically the market shoots up a lot. Now in 2019, 300 to 400 capes will stop to install scrubbers. And as you said, we will not be discussing the scrubber economics now, but probably in the next question.
You can talk about the supply effects of scrubbers,
yes,
not the scrubber economics. That's fine.
If you have 300 ships or 400 ships within a year stopping to install scrubbers, you can understand what's going to happen with the rates. The market is already very tightly supplied. Ships will be stopping. Some people say 20 days. We believe it's going to be way more than that. So that by itself is going to create a huge supply issue that's going to drive the rates.
And the ships that don't install scrubbers are going to have to stop for, we think, the better part of a week to clean out all the sludge in their ballast, in their bunker tanks.
And make other upgrades as well.
Yeah, but proportionally it's only a day, 2 days comparison with the scrubber that is 30, 40 days, no?
You think it can be 2 days? We don't think it's 2 days. We think it's, more like, the better part of a week.
No, it's not only that. It's not only to get rid of the sludges. You also need to upgrade various equipment on board the ship in order to be able to burn MGO in the long run. So it's definitely not 2 days. It might be a week, it might be more, but you certainly need to do upgrades on the ship in order to burn MGO.
1 day is just to put the fuel. So we need 1 day to refuel the vessel, and then we'll see how many other days they are needed. Of course, I don't think this, all these tanks will be cleaned so thoroughly as everybody expects. But again, there will be some requirements for other pumps. The other thing that we don't mention at all, we speak always about scrubbers, and this is of course an optional equipment, but we do not speak about ballast water treatment, which is an equipment that has to be installed. So there are so many ships that have not yet installed. They took exemptions, and these exemptions were for 2019, 2020, etc. There are so many ships that were constructed in, let's say, in Chinese shipyards that have equipment, ballast water treatment, which is not U.S. Coast Guard approved. So we have all these interventions that they need to take place, and the ships will not stop only because of scrubbers. They will stop also to install ballast water treatments. And again, this installation could take 14, 15, 16 days, 20 days, because not all ships go to the best shipyards of the world. Sometimes some ships go to, let's say, a very reliable shipyard, and they can do it within the time frame of a regular dry docking, but some other ships will be stuck there. So we're quite confident that the downtime for ships, for scrubbers and for ballast water treatment will be substantial. At the same time, the industry will benefit in 2020, immediately after 2019, from the slow steaming that the vast majority of dry bulk vessels will need to go, because it will be directed by the charterers, because the charterers wouldn't like to pay, let's say, 30 tons with an excess cost. Maybe we'll ask the owners to go slower and burn 25 or 24 tons. And that could be also another important factor that will affect the supply.
Yeah, on your ballast water treatment system, I think that's a big point. I come at it a little differently in that it's a high cost. If you have a 20-year-old Cape, are you really going to put a ballast water treatment system and spend $1 million? I don't know. That's a big question, particularly when you're talking only 4 to 5 years of useful life after that. But the biggest thing, I think, as the price of fuel goes up significantly, at least for the first couple years as 2020 is introduced, particularly in the Capes that are doing long-haul trades and burning a lot of fuel, I think from an economic standpoint, it will force scrapping. I think some of these older ships that consume an inordinate amount of fuel will be somewhat uncompetitive in terms of bidding for iron ore in the majors. So I do think it's going to force scrapping. I think it's going to be more of an economic, though I agree with everything the other panelists have said in terms of downtime, in terms of installing scrubbers and ballast water treatment. But from a financial standpoint, I don't know how a 20-year-old Cape competes in a $800 a ton fuel environment.
$800. So you expect the fuel price to go out. So we're going to touch upon that later. But if we so have anyone done any calculations or seen numbers if you take cleaning of the tanks, installment of scrubbers, ballast water, what supply effect that could have?
It's 2 to 4%. We think. Call it 2. That's the conservative end of that is safer.
So 2% on those three parameters.
Yeah.
Would everyone agree on that? Or?
Well, I think it's going to be higher than that because people now, like Loukas said before, people assume that the ships will be stopping at yards that they will deliver on their promise about certain dates. You have weather disruptions in China, you have other elements, and of course the Chinese have the tendency of overbooking and under-delivering in a number of ways. We have had a lot of incidents recently about ships getting into the yards to install scrubbers, quality scrubbers at quality yards, and instead of 20 to 30 days, the ships ended up to 2 months. So we think that the supply disruption will be much, much bigger than that.
Yeah. Also more in line with the 4% than the 2%, I think I fully agree. You can rely on Chinese, but there is always delay, bad weather, bad experience, and probably the capacity will be taken out from the system. So 3-4% is probably more in line with that.
So with Hamish say 2% and you say 4% excluding scrapping, just the
Scrapping for next year, I think, is very difficult, to be honest.
Okay. So if we summarized on the dry bulk demand, around 4% ton mile sounded fair. From what I hear, I think we might be very, or our supply numbers might be a bit high. If you'd like to comment, we have 2.4% net supply growth in 19 and 2.8 in 2020. If we start to the left with Hamish, is that too low, fair, or too high?
Well, I think the supply growth, in other words, deliveries less scrapping, is probably right, but the effective supply in 2019 is going to be reduced because of unusual, let's say, stoppages of ships by, we would think maybe 2% to perhaps 4%, and I think the other side of the table is sort of 4 to perhaps a bit less, but more like 4, so. Net supply growth.
So it could be closer to 0.
It could be for 2019 closer to effectively 0.
Okay.
Yeah.
Are you then taking into account slow steaming? We'll touch upon that later.
No.
Or is that another factor?
That's
We're going to touch
another
upon it
factor.
Later. Okay.
And that the other factor will apply in 2020 and not in 2019.
Yeah.
Yeah, but you have demand growth. If you have 3 to 4% demand growth in a market that will be effectively growing by 0, or let's say minus 1%, you can imagine, that's what that is going to mean to the rates.
So I tend to believe everybody will be happy. People who are not installing scrubbers will be happy because they will take the advantage in 2019. People who are installing scrubbers will take the advantage in 2020. So everybody should be happy.
Except people who have stuff they need to ship.
Okay.
You need on the water in 19.
If we then move...
If I may say another point, which is interesting, also, in order to install all these scrubbers and all these ballast water treatments, some people think that you need to spend some money. And you need also to spend some equity from your reserves. We're coming out of a cycle which was extremely bad. The companies are not full of cash. And so this will also indirectly affect the order book, the future order book. So you cannot do two things. You cannot install scrubbers and also do ordering of new builds. And also, either you do an additional order or you install some scrubbers. And the second point is that also the trade war, as we discussed, is also another parameter that plays an important role in whether you need to put an additional order in shipyards. So this is the good effect that will prolong this cycle, that we have, let's say, this fear of trade war. We have all these other investments that we need to do one way or the other with ballast water treatments and with scrubbers. And imagine that the ballast water treatment could be 700,000, 800,000. A scrubber could be 2 to 3 million for a, let's say, for a medium-sized vessel. So at the end of the day, you pay this money, so this money are not available for other investments, so are not available to expand your fleet with new builds, which is also another interesting idea.
The order book is quite low in dry bulk, and then with the supply pictures, I think we will probably have to have a revisit of our supply figures. So we'll see. If we move over to 2020 impact, this is a chart shown in our latest IMO 2020 report, where we, on the x-axis, show the number of vessels as a percentage of the fleet, and to the left we rank the ships with the highest fuel consumption. And on the y-axis we have share of global fuel consumption. And then I would see, if you take the 5% most thirsty ships, you would have about 40% of fuel consumption globally. But dry bulk, you rank Capesize number 8 and Panamax number 11 on this chart. But nevertheless, you're one of the sectors ordering the most scrubbers. So Per, why did you in Golden Ocean order scrubbers?
We have taken a more kind of risk management approach to it. We think it's, first of all, you have the financial aspects that you touched upon, the spread. It seems to be a good investment. And I don't think this is a long-term solution for the industry in general. Yeah, we are installing in more or less half of the fleet. And we also tie it in with the regular dry dock schedule in order to limit the off-hire period. So it's, from a financial point of view, it makes sense to do the investment for those reasons. We also think that the older vessels will lose out in the competition in 2020. So it's more favorable to install in the older vessels rather than the new and fuel vessels.
And John, it seems like you're also joining now on the Capes.
We are.
Yeah. Are investors giving you pushback, or for you have to install scrubbers?
No, not at all. In fact, I'm actually surprised how little questions that we get on this. But look, we're taking a portfolio approach on it. We're putting scrubbers on all 17 of our Capes. We think that makes sense. The payback period, even at a $200 spread, which is most likely conservative, is still a year. So we think that is a pretty much a slam dunk from an investment standpoint. We're not immediately. We haven't immediately made a decision on what we're going to do with the smaller ships, but we're maintaining the options on at least 15 more. And if you look at our Capes, our 17 Capes out of our fleet, that's 41% of our overall fuel usage. And if we add in the options, that's another 20%. We still haven't established in our mind the case for the smaller ships quite yet. It's a longer payback, and I think there's some more unknowns on the smaller ships in terms of availability of high sulfur fuel in some of the smaller ports that are mid-sized and smaller ships call. But for us on the Capes, we think it makes a lot of sense, obviously, and we've spent a lot of time on this. So we expect to have all 17 done before the end of 19, and we have some that are being dry docked. We're having some that we're rolling forward. But we also are happy that we have waited to some degree on this, as some of these larger Chinese yards have gained the expertise in terms of installing the scrubber equipment, so you can keep the number of days that the ship is in dry dock to a minimum.
Hamish, would you like to add some comments? You've ordered a few.
We've ordered some. Yeah.
As a small hedge.
As primarily a hedge. As primarily a hedge. No, we've basically, we intend to put scrubbers on our entire fleet, and we think the profitability of those scrubbers will have the greatest duration in the smaller vessel classes, and the greatest initial magnitude in the larger vessel classes. And after a period of time, there won't be any profitability for the larger vessel classes. It will simply be a requirement to do business.
If I may say a couple of things about the fundamentals of scrubbers, because quite often, and also for the audience, for the benefit of the audience, we do not understand what this device does and whether it's suitable or not for cleaning. So first of all, today that we are speaking, all ships are not, most of the ships are not equipped with scrubbers, and the result is that the sulfur that is inside the fuel that they are burning, it goes to the atmosphere. It dilutes with the humidity, it becomes an acid rain. If the acid rain goes anyway, wherever there is a rain, so it can go to the sea or in the land. We don't care if it goes to the sea, because the sea is alkali and it neutralizes. We care when it goes to the land. That's why the IMO back in 2008 had introduced these ECA zones, and you say, don't burn high sulfur fuel close to United States. Don't burn in Baltic region. So that's why let's say the various parts of the world try to push the high sulfur content fuels away from the shore. So this acid rain will not come to the land. So, but itself, whatever is produced today, it goes basically to the sea and is neutralized. The same thing will happen, but in a very ordinary way with scrubbers. The scrubbers will make impossible, let's say, the escape of sulfur to the atmosphere, and it will neutralize it into the sea. The second point is that scrubbers is a very old technology. I mean, back in 1970s, 80s, so it's so I think that it will be useful for several years. This is one way. And I think that, I tend to believe that the necessity of cleaning the exhaust gas with scrubbers, the exhaust gas from sulfur with scrubbers, is very important because crude oil itself, we have several crude oils. We have crude oils with high sulfur content, and there it's economical to take out the sulfur, and you have crude oil with very low sulfur, which is okay for our case, but also you have crude oil with medium content sulfur, which you cannot, it's not economical to take it out. So either you spend money in the refineries, which means that the fuel will cost more, and you don't install scrubbers, or the cost will be less with the scrubbers. So I think the economics are there. Also the HFO, the heavy fuel oil that we discussed, is a big percentage of the crude oil. So the production itself is unavoidable. Either you use it as it is, with high or low sulfur, whatever it is produced, or you need to send it to a cracking, to have a cracking methodology and make other, let's say, fuels. If you do that, it's again an additional cost. So all these economics are, let's say, I believe that they are in favor of the companies that will install scrubbers at the end of the day. And these scrubbers will work for several years, for 10 years, for 20 years. It's not for 1 or 2 years.
Okay, I just want to show one slide more. These are numbers we subscribed to, provided by DNV. As of August, they counted about 1,000 scrubbers. And then by September, it went up 300. And by October, it went up an additional 300. We count that there is about currently 15% of the Cape fleet would have installed scrubbers by 2020. And our forecast is that about more than a third of the Cape fleet will have installed scrubbers by 2020. Would the ship owner manage to retain all the saving? Stamatis?
Well, first of all, I agree that the scrubber installation and the usage for the next few years appears to be mathematically, a good exercise. Some people say that the payback may be like a year. Some people say that the payback may be prolonged to 3 years. I don't know, and nobody knows what's going to happen. Personally, when I hear companies admitting in the investment of hundreds of millions of dollars, regardless if that's equity or debt or whatever, I find it a little bit problematic for the shipping community because it's a silent acceptance that the cost of all this investment will be borne by the ship owners, which in my opinion is wrong. That should be made in cooperation with the charterers, and the cost of the actual investment and all that should be passed to the end consumer, whoever the end consumer may be, as this is happening in all the industries in the world. For example, if you have higher fuel cost on the airplane, the passenger pays the cost. If you have a higher fuel cost at the gas tank, unfortunately, the consumer pays the cost. In this case, if everybody goes out and says, I will install 100 scrubbers, 200 scrubbers, 300 scrubbers, or whatever, that means it implies that the cost will be borne solely by the shareholders of these companies. And that, in my opinion, is not so correct.
Of course, if the shareholders bear the cost, the shareholders get the profit.
If there is a profit,
the charterers bear the cost, the charterers get the profit.
I'm not sure who's going to have profit or who's going to have losses. As a company, we have decided that the scrubber installation for Seanergy, which, as you all know, it's the only pure play Cape-size fleet, will be done in cooperation with the charterers. So we have entered into agreements that we will be sharing the cost and we'll be sharing the upside and all that, because it's not only what the spread looks to be from 2020 onwards, which it might be $1,000, it might be $100, I don't know. But the thing is here, the availability of fuel. and who's going to have the responsibility of providing the high sulfur fuel oil and all that. So in our opinion, that is an exercise that should be done in close cooperation with the charters and not by the owners themselves.
But Hamish, let me challenge you, Hamish, in terms of if you're in Brazil and there's 2 Capesize with scrubber, 2 Capesize without scrubber, and they're competing for cargo, how would that bidding process in terms of retainment for scrubber?
Well, we don't intend to time charter our scrubbed ships. We intend to voyage charter them, and therefore we'll just carry the iron ore for the same price per ton that the market will bear. Nobody even knows whether which ship we're going to use. We'll just say we'll carry, your iron ore at the market price per ton, and we'll get the profit.
Okay.
Yeah, no, I think Hamish is exactly right, and that if a shipping company is making the investment on scrubbers, that is really the key. Is you really need to be doing direct cargo liftings, voyage chartering, so you can reap 100% of the benefits. And I mean, look, I've talked to, over the last week, all the iron ore majors. They all expect the price of shipping iron ore to go up. So they've all, I think, rationalized that they are going to have to pass that cost on to the end user. And also, again, the reality, if you take 170,000 deadweight ton stem of iron ore from Brazil to China, or even Australia to China, the economics aren't that much different. You're talking about a $300 spread, maybe a 4 to 5% increase on the total cargo. That's not a huge inflation number. And that number obviously trickles down and dwindles to 1 to 2% once it gets into the steel industry. So I don't think it's that big of a deal, and I think ships with scrubbers are simply going to compete just like any other ship. It will just reap higher economic benefits.
I think John and Hamish are right. The problem is when us owners are giving on charter the ships to a charter or an operator, are they going to have the same logic? Because probably they are just going to pay you $1,000, $1,500 more, and they are going to look for making money. So maybe they are going to be a little bit more competitive than the non-scrubber ships. So if all the scrubber ships are in the hands of the owners and all of us work together, I see it. But if we naturally giving ships to third-party people, it will be difficult to get all the value. Plus, normally when you are doing on the day-by-day, trying to get cargoes, if you want to participate and you want to get the cargo, you have to discount. So whatever you want or not, you will have to leave some money on the table.
Look, if I may say...
comment. I think Carlos is into something there, because you said that we need all the owners to be disciplined, and the big question mark is whether that is possible or not. It can be tempting for a guy with a scrubber, if he competes with a guy without the scrubber, to lower the rate a little bit to secure the cargo. So I think you have a point, actually, Nicolay, on that. So discipline is a crucial thing.
If I may say something here, it's not about this. Just a minute. It's not about discipline. Yeah, just have a second. It's not about discipline. It's very clear. We have, the development of two-tier market. You will have ships with scrubbers and ships without scrubbers. If you have a substantial percentage of ships without with scrubbers, then the indexes need to be modified, and I think that there will be, and there is such discussion. So you cannot, let's say, you have a Panamax, you have a Kamsarmax. The indices are modified for the performance of the ships. If you have scrubbers, the indices will be modified. You will have, let's say, you said that you have about 15%, 30% of Capes. This is a very good idea. In Capes, they will have 2 indices, the one for scrubbers and the other without scrubbers. This is a very good idea. We have a tight
schedule today, so I'm going to interrupt you. I've been
one final point.
This panel suggests that you will have 4% demand growth and 0 supply growth next year. So that looks quite optimistic based on where rates are today. Thank you.